Imagine you're sitting across from your financial advisor and they tell you the one thing you've counted on your entire life, the bedrock of every retirement plan since the 1980s, is no longer true. Imagine they tell you that government bonds, the risk-free asset, the thing your parents trusted, the thing you trusted, might actually make your portfolio less safe. Sounds impossible, right? Sounds like conspiracy theory, but it's not. It's happening right now. And if you are retired or planning to retire within the next decade, the next 12 minutes might be the most important 12 minutes of your financial life. Because the bond market isn't just fluctuating, it's breaking. And the diversification you think you have? It's an illusion. This is not about another market dip. This is not about waiting for the Fed to cut rates and everything going back to normal. This is about a structural shift so profound that the world's largest asset manager, BlackRock, who oversees nearly $12 trillion, has issued a stark warning. Traditional diversifiers like long-term treasuries do not offer the portfolio ballast they once did. Let that sink in. The thing that is supposed to catch your portfolio when stocks fall, the government bond, is no longer doing its job. To understand why this is happening, we have to go back to a time before you started investing. We have to go back to the 1970s. Because history doesn't repeat, but as Mark Twain said, it often rhymes. And right now it's rhyming with a very dangerous verse. For 40 years, from the early 1980s until just a few years ago, we lived in a golden age for bonds. Interest rates fell from nearly 15% to nearly zero. When interest rates fall, bond prices rise. It was a one-way bet. And more importantly, when stocks had a heart attack, like in 2000 or 2008, investors panicked and bought treasuries. Why? Because the US government was considered the ultimate safe haven. This created a negative correlation. Stocks down, bonds up. It was the perfect hedge. It smoothed out the ride, allowing retirees to sleep at night while still owning growth assets. But that relationship, that 40-year marriage between stocks and bonds, is getting a divorce. And the separation is ugly. We saw the first hint of this in 2022, the worst year for bonds in history, when both stocks and bonds crashed together. Many of you probably thought that was a fluke, an anomaly caused by a sudden spike in inflation. But the data suggests this isn't an anomaly, it's a regime change. According to MSCI, the financial analysis firm, we are seeing the return of the triple red scenario, where US stocks, US treasuries, and the US dollar all fall at the same time. This happened briefly in April of 2025, and again in January of 2026. These aren't just blips on a chart. This is the market telling us that the old rules no longer apply. But why? Why would the safest asset in the world suddenly become unreliable? To answer that, we have to look at the elephant in the room. The elephant that no one in Washington wants to talk about, the elephant that is currently eating the entire living room. I'm talking about debt. U.S. national debt. Here's a number you need to remember, 120%. According to the nonpartisan Congressional Budget Office, by 2036, U.S. national debt will hit 120% of gross domestic product. That is higher than the record set just after World War II. But here's the kicker. Those numbers do not include the massive, yawning holes in Social Security and Medicare. When you add those unfunded liabilities, the hole gets much, much deeper. We are effectively sitting on a debt load that exceeds anything this country has ever seen during peacetime. Now, for decades, we've been told not to worry about this. We're the United States. We print the reserve currency, and we can always pay our debts. But markets are starting to ask a very uncomfortable question. At what point does the borrower become less creditworthy? If you were a bank and a friend came to you asking for a loan, and that friend already owed 120% of what he earned every year, and he showed no plan to cut spending, and he kept arguing about raising the debt ceiling, would you lend him money at a low interest rate? Probably not. You'd charge him a higher rate to compensate for the risk. This is the trap. The U.S. government is now financing over $1 trillion a year in interest costs. That's trillion with a T. As interest rates stay higher for longer, that cost explodes. It becomes a vicious cycle. Higher debt leads to higher interest payments, which leads to more debt, which leads to even higher interest rates to attract buyers. And who are the buyers? For years, it was foreign governments, pension funds, and retirees like you. But those buyers are getting nervous. Let's look at the math. For the first time in many cycles, the return forecasts for bonds are actually within shouting distance of stocks. Morningstar aggregated forecasts from Vanguard, BlackRock, JP Morgan, and others. Vanguard is now predicting U.S. stock returns of 3.5% to 5.5% over the next decade. Meanwhile, they predict U.S. bonds will return 3.8% to 4.8%. Think about that. The gap is razor thin. You're taking all the risk of the stock market for maybe 1% more return. But here's the terrifying part. Research Affiliates, a highly respected firm, goes even further. They predict U.S. large cap stocks will return only 3.1% over the next decade, while bonds return 4.7%. In this scenario, bonds actually outperform stocks. That sounds good for a retiree, right? But why are bonds outperforming? Not because the economy is strong, because the growth outlook is so weak and the risk is so high that the tiny, safe return starts to look competitive. It's not a vote of confidence, it's a vote of fear. But here's the real danger for your retirement portfolio. It's not just about low returns, it's about correlation. When stocks and bonds move together, the entire concept of a balanced portfolio goes out the window. The classic 60-40 portfolio, 60% stocks, 40% bonds, was designed to smooth volatility. When stocks zigged, bonds zagged. But when they both move down together, you have nowhere to hide. MSCI ran a stress test. They looked at a scenario mirroring the 1973-74 stagflation era, a time of policy paralysis, external supply shocks, and eroded central bank credibility. Sound familiar? They found that in a prolonged triple red episode, a global multi-asset portfolio could lose approximately 13% in US dollar terms. For a retiree taking distributions, a 13% loss isn't just a number on a screen. It's real money. It's selling assets at a loss to pay the electric bill. It's the sequence of returns risk that financial planners lose sleep over. If the market drops early in your retirement and you have to sell, you never recover. You run out of money 20 years from now because of a bad 3 years today. And this isn't just theoretical doomsaying. Let me give you a concrete example from the very recent past. In April 2025, a tariff shock hit the markets. For a brief period, we saw the triple red scenario play out. A hypothetical 60-40 portfolio held by a foreign investor dropped about 12% in just 2 weeks. That's the speed of modern markets. The old bond buffer wasn't there. It was just a gut-wrenching drop across the board. So we have a problem. The traditional hedge is breaking. The safe harbor is looking less safe. And the debt load is becoming unsustainable. But before we get to the solutions, and there are solutions, you are not helpless. I want you to understand the hidden leverage that could turn a market dip into a full-blown avalanche. Because there is a ticking time bomb in the global financial system, and it is hidden in plain sight. It involves hedge funds, the UK, and over $3 trillion. We just talked about the macro forces breaking the bond market, the debt, the correlation shift, the end of the 40-year bond bull market. But there is a mechanical, structural reason why this situation is more fragile than it looks. It has to do with something called the repo market. Now, stay with me. I know that sounds like jargon, but it's actually simple and it's terrifying. Imagine a hedge fund. This hedge fund wants to make a bet on government bonds. They think interest rates will go down, so they want to buy a ton of bonds. But they don't have all the cash. So they take the bonds they already own, they walk over to a bank, and they say, I'll give you these bonds as collateral. You give me cash. I'll use that cash to buy more bonds. I'll pay you back tomorrow. That's a repo transaction. It's a short-term loan, usually overnight, secured by government debt. This market is massive. It's the plumbing of the global financial system. And right now, according to the Financial Stability Board, which is led by the Bank of England, hedge funds have piled into this market to an unprecedented degree. They have placed a record-shattering bet on government bonds, using leverage of about $3 trillion. To put that in perspective, that's roughly the size of the entire German economy, borrowed overnight, to buy government debt. The Bank of England is so worried about this that they issued a warning in February of 2026. They said these hedge funds have accumulated sizable and riskier positions, and that this poses a systemic vulnerability. Why? Because if something spooks the market, say a surprising inflation report, or a debt ceiling fight in Washington, or a geopolitical event, the banks that lend the money will get nervous. They will demand their cash back, or they will demand more collateral. This is called a margin call. Now imagine you are that hedge fund manager. The bank calls you at 9 a.m. and says, we need another $50 million in collateral, or we are selling your bonds. You don't have $50 million in cash sitting around. So what do? You sell bonds. You dump your treasuries onto the market to raise the cash. But if every hedge fund does this at the same time, you get a fire sale, a massive wave of selling. This drives bond prices down. When bond prices go down, yields go up. When yields go up, it becomes more expensive for the US government to borrow money. It becomes more expensive for companies to borrow money. It becomes more expensive for you to get a mortgage. And here is the kicker. The Financial Stability Board warns that banks, fearing for their own safety, will pull back their lending precisely when it is needed most. They call it a sudden withdrawal of liquidity. This is exactly what happened in the UK a few years ago, when the gilt market, UK bonds, nearly collapsed. It took the Bank of England stepping in to buy bonds to stop the crash. But the US market is much, much bigger. If that mechanism breaks here, it's not a bailout, it's a global financial crisis. So you have the fundamental problem of debt, and you have the mechanical problem of leverage. These two things are on a collision course. And where does that leave you? The person who played by the rules the person who saved diligently, the person who bought bonds because they were told they were safe. It leaves you in a position where you cannot afford to be passive. You cannot afford to just set it and forget it in a target date fund that assumes the next 40 years will look like the last 40, because they won't. Now, I want you to take a breath. I know this sounds grim, but awareness is the first step to action. The goal here is not to scare you into selling everything and burying cash in the backyard. The goal is to arm you with the truth so you can adapt. In just a moment, I'm going to show you exactly what the smart money is doing right now. How BlackRock, UBS, and Merrill Lynch are advising their wealthiest clients to navigate this new world. We're talking about specific strategies, bond ladders, tips, mortgage-backed securities, and even international bonds that can actually protect your income. But first, I want you to do something. I want you to pause and think about your own portfolio. When is the last time you looked at your bond holdings? Do you own individual bonds or bond funds? Do you know the duration? Do you know how sensitive they are to interest rate changes? If you can't answer those questions, you're not alone. Most people can't, but that ends today. After this video, you will know what questions to ask. We are at a historic inflection point. The rules have changed. The question is, will your portfolio change with it? And let's get into the specifics. Because the most dangerous thing you can do right now is nothing. The second most dangerous thing you can do is panic and move everything to cash. Because while bonds are facing a crisis, cash is also a trap. Here's the trap with cash. In 2024, it was great. Money market funds were paying 5%. It felt like free money. But the Fed started cutting rates in late 2024, and they are expected to cut again. BlackRock estimates that by the end of 2026, the income from $1 million in cash will have dropped significantly. You are experiencing rate decay. If you're sitting on a pile of cash earning 4% now, and inflation is running at 3%, your real return is 1%. But if rates drop to 3% next year, your real return is 0. You are standing still, losing purchasing power to inflation every single day. Cash is not a long-term strategy. It's a parking spot, not a destination. So, if cash is dying and long-term bonds are breaking, where do you go? You go to what the experts call the sweet spot. You go to intermediate duration. Look at the data from UBS and Morningstar. Intermediate term bonds, those maturing in 5 to 10 years, are currently offering the best risk-reward trade-off. Why? Because if we do enter a recession, or if the market cracks, rates will likely fall. And when rates fall, intermediate bonds will appreciate in price. You get the yield now, plus the potential for capital gains later. It's not as volatile as long bonds, which get crushed when rates rise, and it yields more than short-term bills. This is where the smart money is rotating. But which bonds actually make sense now? This is where selectivity becomes critical, because not all bonds are equal. One attractive area is U.S. agency mortgage-backed securities, or MBS. These are pools of home loans backed by government-sponsored entities like Fannie Mae and Freddie Mac. They carry A ratings, just like treasuries, but currently offer higher yields. That yield premium exists without taking extra credit risk, which is why large institutions are leaning in this direction. Another overlooked area is local currency emerging market debt. It sounds risky, but consider this. If you own U.S. treasuries, you are already exposed to a country with very high debt and political dysfunction. Many emerging economies actually have lower debt-to-GDP ratios, more inflation-focused central banks, and significantly higher yields. Even better, in a triple red scenario, the dollar often weakens, meaning local currency bonds can benefit from currency appreciation, turning them into a hedge rather than a risk. Next, think beyond traditional bonds. TIPS help protect purchasing power by adjusting with inflation, which matters far more than headline yield when you're living on fixed income. On the equity side, dividend stocks still matter, but only if chosen carefully. The S&P 500 has become extremely concentrated, with most income-like growth sitting in a handful of companies. Instead of relying on that, look towards sectors built for stability and cash flow, such as healthcare, infrastructure, and select European or UK equities, where dividend culture is stronger and valuations are cheaper. This isn't about chasing growth. It's about diversifying income sources so your retirement isn't dependent on a single market narrative. Finally, structure matters as much as selection. Bond ladders allow you to lock in yields and eliminate duration risk by holding individual bonds to maturity, giving you predictable cash flow regardless of market volatility. And for core living expenses, annuities deserve a fresh look. Modern annuities can provide guaranteed income for life, acting as a contractual hedge when markets fail to diversify. So the new playbook is simple. Stop relying on long-term treasuries alone, reduce excess cash that inflation erodes, build ladders instead of bond funds, diversify income intelligently, and secure a portion of guaranteed income. The bond market may be breaking, but your retirement plan doesn't have to if you adapt with intention.